Okay, hello everyone. Welcome to the second part of our lecture series. So I won't be reading any script anymore so that we would be more efficient insofar as the time of our lecture is concerned, and that to keep the discussion as spontaneous as possible. Okay, so in this part of our lecture, we will be talking about the various underlying assumptions in accounting. When we say underlying assumptions in accounting, it talks about the different principles, okay, that are provided by the generally accepted accounting principles, which will now serve as our guidelines in carrying out or in performing the different phases now in the accounting process. So you have to pay attention to the details, to the rules that we will be discussing, because these are the very guidelines that you have to follow later on when we already go to the specific phases in the accounting process now. Okay, so in this particular lecture, we should be able to understand the rules provided by the following. So we will be discussing about accrual basis of accounting. We will also be discussing about the accounting entity assumption. You have your monetary unit assumption, periodicity assumption, matching concept, and of course your going concern assumption. Okay, so let us start in discussing first the rule set forth by the accrual basis of accounting. When you say accrual basis of accounting, it gives us the rule to follow in the recognition now of your income and expense accounts. Okay, so the question that must be answered by this particular principle is that when is the proper time that an income account or an expense account is going to be recognized or recorded in the books or in the journals now of the business. So to answer that, we have to take note of this rule, that a revenue or an income is recorded only when it is already considered earned, regardless of collection. Okay, for expenses, on the other hand, it is only recognized when incurred, regardless of payment. So let us discuss separately the rules for the recognition now of income and expense. Okay, in recognizing income, it is important for you to first determine the type of business activity involved in the problem. Okay, meaning what type of activity is the business engaged in. Okay, generally we have three types of business activities that any business may adopt. So we have what we call your, okay, right, we have what we call your servicing. Okay, servicing or your service type of business. When you say servicing, the product that they provide is something intangible. When you say intangible, you cannot describe that particular product or the thing using now your five senses. Okay, the only way for you to derive the benefit of that particular product is by experiencing it. Okay, so that's for a service. The other two types of business activities are the following. We have what we call your manufacturing, okay, and your merchandising. Alright, when you say manufacturing, the business is engaged in the conversion of raw materials. Okay, these raw materials are going to be processed by the business, and once processed, they are going to be converted into a finished good, which finished goods are going to be sold to the customers. It is very different for a manufacturing type of business, because in merchandising rather. In a merchandising type of business, the business does not process raw materials into finished goods. They purchase finished goods, and those finished goods are going to be sold at a markup now. Okay, But what is similar between a manufacturing and a merchandising type of business is that they sell, okay, a product that is considered tangible. And how do we call these types of products? We call them your goods. Okay, so there are two types of products, service and goods. Service, of course, is provided only by servicing type of businesses, while goods, which are tangible, meaning you can describe them using your five senses, are provided either by a manufacturing type of business or a merchandising type of business now. Okay? So if it is a service type of business, when is an income or a revenue considered earned? An income or revenue is considered earned only if the service is already rendered to the client. When you say rendered, the business already provided the service to the client such that the client already derived the benefit from that particular service now. Okay? Whether or not there is already a collection made by the business is not important. What is important is that the service is already rendered. And from that time, an income or a revenue should be recorded or recognized in the books of the business already. Okay? It would be different if we talk about a manufacturing or a merchandising type of business, because in these types of businesses, an income is only considered earned if the ownership, okay, the ownership over the goods is already transferred from the seller to the buyer. So at the moment the buyer owns the goods already, okay, that is the time also that you have to recognize or record your income, okay, the income account in the books or the journals of the business now. So no income is going to be recognized yet if the good is still owned or the goods are still owned by the seller. Okay, so we have to be very clear on that particular rule now. Also, the fact that there is already a collection made is not important in this case also. So what is important is that the goods are already sold and that the ownership over these goods is already transferred from the seller to the buyer now. So that is for income, for the recognition of an income now. For an expense, the rule states that an expense is recognized only when they are or when it is already incurred. So if we say incurred, this may be a very new term for you. When you say incurred, it simply means used. Okay, so what are we going to use so that an expense shall be recognized? When an asset, okay, is already used, then that's the time, that is the proper time that an expense should already be recorded or recognized in the books or the journals now of the business. Okay, the fact that you already paid in cash, okay, in buying that particular asset is not important for the recognition of an expense, okay, because that is not the very criteria that you have to take note in recognizing an expense. The only criteria that you have to consider is that an asset is used. So at the moment an asset is used, then that is also the time that you have to recognize an expense. Okay, so for you to better understand these particular rules, let us apply them in problems. Okay, so let us read the first problem. On January 5, 2020, ABC Company agreed to render its services to XYZ Incorporated on January 25, 2020. XYZ Incorporated already paid the cost of services on January 5, 2020. So again, the first thing that you have to do is to determine first what type of business activity is involved in the problem. Okay, in this particular problem, the business activity involved is a servicing activity, okay, or a service activity here now. So when do we recognize an income for a servicing type of business? At the time the service is already rendered, okay, to the client. Who is the client? In this particular case, we have XYZ Incorporated. Okay, so what are the dates that are involved in this particular problem now? We have January 5 and we have January 25. Okay, what transpired on January 5? On January 5, only an agreement was made, right? Only an agreement that the service will be rendered on January 25 has transpired on January 5. Okay, the actual provision or rendering now of the service will happen subsequently on January 25, 2020. So the question here now is, when is the proper time that you are going to recognize now your income or your revenue in this particular case? That should be on January 20. Okay, January 25. The fact that the service is paid in advance on January 5, 2020 is not important in this case, because then again, we said that under accrual basis of accounting, collection is not material. Okay, what is material is that the time when the service is actually rendered or provided by the business to the client now, which in this case happened on January 25. Okay, so let us answer another problem. Alright, let's read this particular problem now. Uncle Incorporated rendered its services to Auntie Incorporated on February 5, 2020. Auntie paid the services on February 10, 2020. So this problem still involves a servicing type of business now. Okay, so what do we do first? We have to determine the dates involved in the problem. February 5 and we have February 10. So what is or what has transpired on February 5? What transpired on February 10? On February 5, there is already a rendering of service. Okay, there is already a rendering of service. On February 10, which is a latter date, that is the only time that a collection was made, right? So a service has rendered first, okay, without collecting any money from the client yet, because the money is collected on February 10, which is a subsequent date. Now the question is, when is the proper time that you have to recognize now an income in this particular case? The answer is that should be on February 5, okay, because that was the time when the service is rendered to Auntie Incorporated. Okay, the fact that the service is paid at a later date is not important, because again, income is recognized when it is earned regardless of collection. Okay, so I hope we are clear in the recognition of income. Let us answer a problem regarding expense now. Okay, let's read. On January 5, 2020, ABC Company purchased and paid for office supplies amounting to 20,000 pesos. On January 10, 2020, only 5,000 of the supplies are left. Okay, so the thing that we have to do first here is to determine the dates involved. So we have January 5 and we have January 10. Now, what happened on January 5 and what happened on January 10? On January 5, your supplies, which is of course an asset, supplies is purchased, okay, and already paid. Okay. So when we bought an asset, which is your supplies here, it is already paid immediately on January 5, 2020. Okay. Now on January 10, the problem tells us that only 5,000 from the 20,000 pesos are left. Okay, now what does it tell us? It tells us that already 15,000, okay? 15,000 worth of supplies has already been used. 15,000 is, or supplies amounting to 15,000 pesos are already used. Okay, so the question here now is, when is the proper time that you have to recognize an expense? Should it be on January 5 or should it be on January 10? What does the rule tell us? The rule tells us that expenses are recognized only when they are incurred. And what do we mean by incurred? We said incurred means an asset is used. So in this particular problem, when is the asset? In this case, your supplies are used. It tells us that on January 10, 15,000 is already used. So the proper time for you to recognize your expense should be on January 10. The fact that your supplies were paid, okay, as early as January 5 is not important in this case. Right? Again, the rule tells us expenses are recognized when incurred regardless of payment. So do not forget the term regardless there. Okay? So let us repeat. What is the rule followed under accrual basis of accounting? Accrual basis of accounting states that an income is recognized and recorded only when it is considered earned already, regardless of the collection made. Okay. On the other hand, expenses are recognized when they are incurred, regardless of payment made. Okay, so that's accrual basis of accounting. All right, let us move on to another principle here, or assumption. We have what we call your accounting entity assumption. Okay, so what is the rule under this particular principle or assumption now? It states that the business is treated as a person separate and distinct from the owner or the owners. Okay, so what is the importance in taking note of this particular rule? That in recording transactions later on, you have to know the distinction between personal transaction and business transactions. Because when you say personal transactions, okay, let us write it. You have to know the distinction between personal and business transactions. Okay? Because when you say personal transactions, these are transactions entered into by the owner or the owners of the business now. Okay? So, despite these transactions being made by the owners of the business, so long as it does not affect the business at all, they are not going to be recorded in the books or in the journals of the business. Okay? Because they are personal transactions. They are transactions entered into by the owner or the owners of the business, who are considered different persons from that of the business itself. Okay? So the business is also considered a person here who can enter a transaction in his behalf or in its behalf. Okay? So when a transaction is entered into and it affects the business, then those are the only transactions that you are going to recognize and record in the books of the business now. Okay, so later on we will be discussing more about this one when we answer problems. We will understand more, no? We will know how to distinguish between a personal transaction and a business transaction. Okay, so that's for accounting entity assumption. Now, let us go to monetary unit assumption. This is very simple. When you say monetary unit assumption, all business transactions are recorded and expressed in a particular currency. Okay, so since we are going to exercise our profession later on here in the Philippines, okay, when we are going to prepare our reports, when we are going to journalize later on, everything shall be expressed in terms of the Philippine currency. Alright? So it means that even if you are going to enter into a transaction where a foreign currency is involved, it is important that when you are going to enter the transaction in the books of the business already, make sure to convert that foreign currency to a Philippine peso, okay, before putting them or recording them in the books or the journals of the business. That is what is meant by your monetary unit assumption. Okay, so everything must be expressed in terms of money. Okay, and that when you say money, it must be expressed further in terms of a particular currency, depending on where you are going to exercise the or where you are going to perform, okay, the accounting activities, right? You have to follow, or you have to use the particular currency used in that particular country now. So if you are going to exercise your profession here in the Philippines as an accountant here in the Philippines, then when you prepare reports, financial reports here in the Philippines, everything must be expressed in terms of Philippine peso. Okay, that is monetary unit assumption. Alright, let's move on. We have also what we call your periodicity assumption. When you say periodicity assumption, the rule is that the business shall adopt a standard span of time within which financial statements are prepared, right? So basically, we have two, okay, standard periods adopted in accounting. We have what we call your calendar year and your fiscal year. An accounting period may refer to a calendar year, or an accounting period may also refer to a fiscal year here now. So that when you say calendar year, okay, when we say calendar year shall start on January 1 and ends at exactly on December 31. That is your calendar year. Okay, while fiscal year on the other hand, okay, it may start at any date of the year, any date or any month of the year, provided, okay, it shall end at exactly, okay, 12 months thereafter. Okay, so for your fiscal year, let's say for example, the accounting period started on November 1. Okay, so the business started its operations on November 1 and it applied fiscal year. When shall the fiscal year or the accounting period end? It shall end on October 31. Okay, so the accounting period, which is a fiscal year here, shall begin on November 1 and ends on October 31. That is for a fiscal year. But for a calendar year, there is only one, okay, specific span of time, and that is the accounting year shall start on January 1 and it shall end on December 31. Okay, so you have, okay, when you are going to establish your business later on, you have to consider, okay, what type of accounting year you are going to apply. Should you apply calendar year or should you apply your fiscal year? Well, it's up to you. Sometimes businesses, for convenience sake, so that everything will be convenient, they just adopt their calendar year. Okay, so there. Okay, let's move on to another principle or concept here. We have what we call your matching concept. Okay, when you say matching concept, it talks about the relationship, okay, between an income and expense. You see, when we say starting, when we start discussing, or when we start discussing an accrual basis of accounting, okay, you would already see that income and expense are always discussed together. Okay, that is further supported by this matching concept, that you cannot earn an income without incurring any expense. Okay, so it is impossible, it is not how do you call that, it is not even accepted, okay, that you earn an income without incurring, okay, an amount of expense. Of course, when you are going to engage in the operations of the business later on, there are certain expenses, spendings, okay, that you have to make in order for that income to be earned. Okay, let me give you an example. When you are going to produce a particular product, right? What are the things that you need in producing a particular product? You have to pay for the cost of the raw materials, right? You have to pay for the salaries of the workers who are going to produce that particular product now. Okay, you are going to pay for the electricity, for the water, okay, for the advertisements that you are going to make in order to sell a particular product now. So those types of spendings, okay, are going to be converted later on into expenses, okay, and these expenses are incurred for you to sell a particular product now. That is what is meant now by matching concept, that it is impossible, for a business to earn an income without incurring any expense. Even in banks, alright, banks, well, basically their product there are called financial products. Okay, they are going to use the deposits of their clients in investing, right? And in investing, of course, there are certain expenses involved also, right? The salary that you have to pay for a financial analyst, that is already considered an expense. Okay, so important, that income is earned. Okay, that when an income is earned, well, essentially there are also expenses incurred. Okay, that's your matching concept. And we have now the last one. We have what we call your going concern assumption. When you say going concern, it states that the business has an indefinite existence. So if you are going to perform the different phases in the accounting process, you do not anticipate the early expiration of the business. No, you are going to record the transactions, you are going to prepare the financial reports as if the business is not yet going to be terminated, or is not yet going to liquidate or terminate its existence. Alright, although in the legal field, when using the old corporation code, okay, of the Philippines, under the old corporation code of the Philippines, there is a particular period of time within which a corporation shall apply for the renewal of its franchise. Okay, initially a corporation, at the time it incorporated itself, shall exist for a period of 50 years and renewable every after 50 years. That is under the old corporation code. But just recently, when the new corporation code is already enacted, okay, a corporation can already exist for an indefinite period of time without the need of renewal of franchise. Okay, so that made okay, the lives of accountants easier, okay, in a corporate type of business, because there's no conflict between the legal provisions and your going concern assumption anymore, right? Because under going concern, the business shall exist for an indefinite period of time. Under the corporation code, corporations may already exist also for an indefinite period of time. Okay, now what is the effect of this particular assumption in accounting or in the books of the business? Well, it has something to do later on with the valuation of your fixed assets, okay, or any of your assets in that case, that your fixed assets shall always be recognized at their cost. When you say cost, okay, that is the original amount for which the asset is purchased. Okay, so later on, when you are going to depreciate, you are going to use the cost of the asset in your depreciation. The only time that you are not going to consider the cost is when you are going to sell it, okay, when you are going to liquidate already. Because when you liquidate, okay, meaning you are going to sell the remaining assets of the business already, okay, you may already recognize your fixed assets at their fair market value. When you say fair market value, that is the price that a seller and a buyer, okay, will normally agree upon. Okay, so that is your going concern assumption. All right, so there you have it.